This is the current federal tax developments for the week of November the 18th, 2024. Current federal tax developments are brought to you by Kaplan Financial Services and Bear State Society of CPAs. I'm Ed Zollers, and this week we have a few things we're going to be looking at here. First among them, we're going to talk about a statement the IRS made at the AICPA Fall Tax Division meeting that, not I should say the AICPA, I should say the IRS made, that they may stop putting taxpayer may rely statements in proposed regulations. We'll talk about why they would stop doing it and, kind of what the consequence of that might be. As well, we're going to take a look at a case where the tax court rules partnership basis calculations are cumulative in nature and are not standalone annual calculations. This is under IRC Section 705A. And this involves an issue where a taxpayer in a year that is no longer open for assessment has claimed losses from the partnership in excess of their basis. What do you do about that situation? How do you handle it? Or did the taxpayer just get away with claiming a loss that will never reduce basis? And that's going to be kind of our discussion as to how that one goes on. Finally, we're going to take a look at some articles that appeared this week in Tax Notes Today, Federal, that just lead us into some areas to discuss about the speculations on what's going to get through Congress in 2025, what challenges are facing, and how quickly, et cetera, are we likely to see something come through. So we can look at those sorts of backgrounds too. Well, let's start off with the IRS's getting rid of taxpayer may rely statements. Now, this was an article by Caitlin Mullaney that was called Treasury Debating Reliance Statements in Future Proposed Rules, that was in Tax Notes Today, published on November the 14th. And this was reporting on a talk that Helen Morrison, Treasury Benefits Counsel, who was speaking to the AICPA Fall Tax Division meeting, which has been going on this past week in D.C., the D.C. area. What was brought up there was a discussion of potential changes in the language that Treasury will include in proposed regulations. And this was specifically triggered based on the idea of what's really necessary, what makes sense in the light of the Loper-Bright decision from the U.S. Supreme Court. For those of you who may forget what Loper-Bright was the decision that essentially said that when the IRS, when the courts are reviewing a final action of an agency, the courts are to look to see whether the agency's interpretation of the law in a regulation or final rule should be upheld as to whether or not it essentially makes sense as the best, or at least one of the very best options for analyzing that law under rules of standard statutory interpretation. There was a lot of back and forth about what that means in the case and how that works. But it is having some impact at Treasury, some of which is not terribly surprising. And I think we're going to see some other consequences of Loper-Bright, not the least of which is I do expect Treasury to rely far more on non-binding guidance, just because the theory will be, if we're going to have to go with statutory interpretation, regardless of whether we have put out an official guide or not, then, why spend the time? Will be one of the arguments that would be made. And in this case, the question is, we look here at proposed regulations, proposed guidance. And generally, in the recent past, Treasury has most often put on each piece of proposed guidance, unless they explicitly wanted you not to be able to use it until a certain date. And sometimes guidance was issued that way. Specifically, nobody should use this unless it becomes a final regulation. But quite often, otherwise, you would see in the preamble to the regulations that, until this becomes final, taxpayers may rely on this in this regulation. Now, again, it's not yet a final rule. So the theory was it was not yet binding on taxpayers. But if taxpayers wanted to be sure they had a position the service would back, they could follow the proposed regs. Now, in this case, what Ms. Morrison said was, if we put a proposed rule out, I think it's understood that is our position. And she went on to say that the IRS would not question a taxpayer's reliance on proposed regulations. Now, probably it's not quite that broad because, as I mentioned, there have been rare cases in the past where the service has issued a proposed reg, The only one that would be a pretty drastic change in the law and how we're doing things, and have told us specifically that taxpayers cannot rely on this reg until and unless it becomes final. So there are cases where they said, nope, we don't want to do that. So because of that, I would still expect you want to check them to make sure that Treasury does not tell us explicitly not to follow them. But it does mean you're not likely to see that outline, which you may have, because we've all gotten used to seeing it. You may have looked there and then wonder, if they don't say that, are we able to follow it? If we follow it, will an agent question us on exam? What should we do? Should we consider other issues or things that could change? I think the theory here is, if Treasury does go this route, they're going to probably, I assume, keep communicating like this, that just because it doesn't say taxpayers may rely on it does not mean this is not the service's position, and that you probably should be, if you want to have the least likelihood of being challenged on exam on the issue, you might want to go ahead and follow what Treasury has said in the rules. Okay, next up, we have a case that came down on October 29th. It's CIRC LLC versus Commissioner, TC Memo 2024-99. And there was a discussion or an article published just today. I'm here on Friday, the 15th of November, in Tax Notes Today, that essentially told us, or discussed this case and whether it was properly decided, and also whether it was or wasn't, how would this decision affect S corporations? So we're going to discuss the CIRC decision. We're going to discuss why it's somehow involved in S corporations when it's a partnership case, and kind of move from there. Okay, let's talk about what the CIRC case was about. So in the CIRC case, we end up having in CIRC is that we have, let's say, a case that often happens to us. What happens when you discover a brand new client and you discover, looking back at their history with this K1, with this partnership, that they've basically claimed losses from a partnership in the past. And you go back trying to figure out what the heck's our basis in this thing. And they've in the past claimed losses in excess of their basis. And some of those losses are in years that are no longer open to an assessment of tax, which also means generally we can't just amend the return and pay that tax, right? Years closed, years done. Now, when that happens, and I'm going to use the example of a brand new client because I'll be honest, CIRC made a couple of really odd kind of errors that are the type of things you would discover if you took on a client. Not only did they fail to notice that they went in excess of basis, these weren't small numbers either, but they also failed to notice they had an increase in basis in a later year. So, yeah, I mean, CIRC has some odd problems computing their basis and figuring out what it was and keeping track of it. We'll just phrase it like that. But for that client who claimed that loss in a year that no longer is open for assessment, I mean, what's the result going forward? I mean, one theory is that the taxpayer just win the tax lottery. In theory, those losses should have been carried forward. Obviously, we're not going to let you carry that loss forward now, right, and claim it again. But did we just win the tax lottery? Are we never going to get a reduction in our basis in the partnership? Because, hey, we put that loss down there. We didn't have a right to claim it. We played the lottery. The service didn't show up. So, hey, we're in great shape. We've got all this basis remaining. Perhaps, did they actually do we use what, and this has been the IRS's approach for a long time, that you used a suspense account in the interim. And what the suspense account would do is it would hold those big negatives, and the IRS knew they couldn't go back to the year where you had claimed a loss you shouldn't have. Rather, what they could do is, instead, they claimed they had the right to sit there and, first thing is reduce your basis, right? The suspense account would be used to offset any increase in basis in the future until such time as you had eaten up what had previously been chewed up, what had previously been deducted that shouldn't have. Now, in one form of the suspense account theory, that would also mean that even if you had, in the current year on your K1, you had items of income and you had items of loss, that what would happen is the items of income would be reported, but they wouldn't create any basis until you got over that limitation. Now, we'll talk about a case we had back in actually 2023 summer that opened up some real questions about how that would work. But at the very least, you would at least get a suspense account that after you had offset gains and losses and got your net addition to basis in the year, before we had any reduction of basis for distributions and the sort, that we would just go ahead and, do that offset and have to eat up the suspense account before we would ever get a deductible loss. So if you had a net loss year, you couldn't claim that loss until you had basically eaten up you'd basically recovered the suspense account. To be able to take care of that and take care of what was there. Okay, that was involved too. The suspense account therefore would eat up basis until we finally got the whole thing offset. Or do those losses continue to reduce basis in a cumulative calculation? As we'll discover, the IRS, when faced with some concerns over the suspense issue that they discovered had been questioned in the S-Corp case we discussed back in July of 2023, the IRS resorted to an analysis of Section 705A and argued that by its plain language, and we're going to hear a lot about that anymore, because following Loper-Bright, expect a lot of arguments to be made upon the plain language of a statute, because Loper-Bright suggests that's going to be the simplest way for a court's decision to be sustained, and it'll be the most effective way for you to win your case, which I think honestly it has been for a while. We have case law that makes it very clear that if the code itself, has one and only one answer from the language of the statute, that is your answer. But now it's getting more attention because after Loper-Bright, people are now making this argument more. So Service said 705A says nothing about an annual calculation. The only place you're going to find an annual calculation is in 704D. We talk about the loss limitation rules. But 705, which is just a general basis calculation, never mentions, any sort of annual calculation where you compute beginning basis, right? You add your income, you subtract your expenses, your losses, you come up with ending basis, and you just do that every year. Now, I know that's the way we do it, right? That is the way we look at it, is a bunch of annual calculations. But the IRS was going to argue 705A says nothing about annual. In fact, explicitly talks about, cumulative losses incurred, cumulative distributions made. So, we're going to be looking at cumulative items, they're going to say, and that's the way you properly do it. And if you look at cumulative, their argument goes, it doesn't matter whether or not it went into a basis calculation, for that year and they screwed it up. It does not impact the basis calculation here a few years later, or, it doesn't somehow magically eliminate ever getting a reduction there. We're doing a basis calculation a few years later. Rather, their argument is all 705 tells us is we don't go below zero when we do the instantaneous calculation, which is what the IRS will claim it's for. So let's talk about this particular case. Now, basically, taxpayer in this case, Circ LLC, is operated as a partnership, and it owned an interest in another partnership. That can get a little confusing because obviously, when they're talking about partnership, we're trying to figure out which one. For all purposes, in this opinion, we're going to ignore the fact that Circ is a partnership. When we refer to partnership here, I'm going to be referring to the actual entity that issued a K-1 to Circ, which is a separate partnership it owned an interest in. Now, in 2014 and 2015, the partnership claimed losses from the partnership that were $3,308,767 in excess of the taxpayer's basis in the interest. Now, the second problem they had occurred later. I think it was 2016, the taxpayer had a 743 adjustment. Now, the opinion says 743. I keep looking at that and keep thinking, shouldn't this be 734? But anyway, whatever it was, they had a transaction, 74 election was in place. There was therefore a mandatory adjustment being made to write up the value. Unfortunately, it appears that they didn't notice that had happened. It was a distribution they made, which is why I thought 734, because, you're buying out an existing partner for cash. You would write up your interest inside based on fair value. But in any event, they had added over $3 million to the partnership. that they own interest in would be added to by this transaction they entered into. They failed to notice that. So let's see, they'd done $3.3 million worth of basis at $3.3 million worth of losses. They had no basis for. And then in a following year, they ended up with $3 million worth of basis they failed to account for. Anyway, at all the mess, right? But in 2017, they had calculated an outside basis of $5,304,992 after they realized they had this $3 million from before, and they went back with their other calculations. The key issue was, in getting at that number, they had never reduced it by the losses claimed in 14 or 15, because when they did their calculation, those years were below zero, so they were going to say, well, you can't have negative basis. And because you can't have negative basis, therefore, pretty much game, set, match, we're done, right? So we're able to kind of ignore that. So that was basically their position. Okay. Now, the IRS, now this becomes a really funny case. After the IRS conceded that 743 adjustment was discovered during the case going through the courts, which also confuses the heck about what was going on. But the IRS conceded, therefore, they had tried to argue that a loss claimed in 2017 wasn't deductible due to these carryover losses. There was lack of basis, etc. Now that they found this other basis, the IRS will concede that the loss they got in 17 was currently deductible. They had enough basis for that. But the IRS now is saying, however, what you think your remaining basis is must be reduced by those losses you claimed in excess of basis from years before. And therefore, we're saying for 2017 going forward, your basis is much lower than you think it is, right? So that was the key issue here. Now, 2014, 2015 had not been under exam, and they were closed. The IRS never came in and disallowed 14 or 15. And as you probably are aware, that's not all that unusual. Quite often the IRS does not come in. Your clients do things like that. Let's face it. Most deductions, most claimed losses from a partnership in excess of basis are never questioned by the IRS, right? They're not really likely to see the issue. Maybe now with more tax basis capital account reporting on the K1s, they'll be able to spot issues quicker. But traditionally, this has not been a strong point of the service, figuring out that people claim losses in excess of their basis. Just wasn't really, it's not really a strong point of the organization. Now, initially, the IRS tried to use the suspense account concept. And as I said, the suspense account said, well, what you do with this is you create a suspense account, right? And basis cannot go above zero with the suspense account until you've accumulated enough positives, adds to basis, to drive the number, to eat up the suspense account. So we stay at zero. So let's say, as we have here, we have $3 million worth of lost carryovers. We would essentially use that $3 million of lost carryovers in a suspense account, and normally they pick this up while it's still at zero. We'd use that $3 million in carryovers, or in that excess deductions, and we would simply sit there and begin offsetting the positive income numbers until such time as, we got back to zero, everything was in line, and then we would start allowing people to, again, claim losses against that additional basis or take distributions from it. Now, the suspense account was something we discussed in the Canwall case. July 2023, the IRS attempting to move for a summary judgment based on their suspense account operations. And that didn't go so well for the service. There was a court order that you may recall, which is what we got out of the case, where the judge had a number of concerns about the methods the IRS had used, using their traditional suspense method. Basically handling that with a suspense account. And the IRS did respond to that about a month later. There was a memorandum responding to what the judge said. But in reality, this case never went to final. So we never had an actual full ruling of anything beyond that initial one, because they settled the case in April of this year. So Canwall case is not going anywhere. But it does appear that the IRS became concerned about using the suspense method. and in particular in CIRC. They were concerned now about it. And they shifted to a cumulative 705A basis theory instead of the suspense theory about how you could handle these losses. Now, as a practical matter, there's going to be some difference in impact between the two, but ultimately it's the same concept. We're going to be offsetting. Those losses are going to come out there and essentially reduce basis. You're not going to be able to get basis. They're going to first thing to do is reduce basis back to zero until you exhaust what's now those old losses. And there's a different theory about why that's true with the cumulative 705A basis theory. In essence, it is that your basis is negative, but because 705 says basis cannot be negative, you just keep sitting at zero with this amount below that is, quote, the real negative basis. But we're not going to recognize that until we can drive basis up above that amount. So that's going to be the basic background. So why is 705A involved, and what's the key thing they're looking at here? Well, the key thing is found in 705A, A1 and A2, and actually A3 as well, which was distributions. But the real catch here is 705A says that you look at your basis like starting with 722 or various other provisions, whatever your beginning is, and whenever you put money in, those would all say that increases your basis, right? Those are all things that add to your basis. Take your basis from there, and then you increase the basis by the sum of your distributive share for the taxable year of income, other items, and prior taxable years. So whatever contributions you put in, we then increase it by the income for all the years we've been in the partnership. Not just this year, but every prior year. We add to that. And we do the same thing on the decreases, the losses and expenses. We decrease our basis by each of those, which basically is our share for the taxable years and prior taxable years. So we start, basically reducing down that. Both of those prior taxable year references here are going to be crucial to how the court arrives at its decision in this case. And that was crucial for the IRS's argument saying 705A requires a lifetime calculation. Now, both cases will tell you, in this case, decrease but not below zero, as you'll see there under 2. So we can't go negative. Now, for distributions, if in fact an amount, that we had here, of the losses, when you have a distribution of the losses, then what's going to happen is those losses, once they hit, if the basis is zero and you still have losses left, then under 704D, there's a special rule that does not allow you to claim a deduction for them, right? And again, that's to keep in line with this. We can't reduce it below zero under 705. So we would have those disallowed losses, which we'd then be able to use in a future year. They wouldn't be lost for good. Is the theory of this. We use them in a future year. I'll get that out. And then in that year, it would reduce our basis. Okay, continuing on. Now, the taxpayer argued the proper treatment really should be, it's just IRS is late, the statute's closed, right? So they use the concept of really, theoretically, a year-to-year computation, remembering that basis cannot go below zero. So basis can never go below zero. That in their reading of the 705A and 704D, their reading was, well, basis never goes negative, and we do this on a year-by-year computation, which is pretty much the way everybody does it, right? We all sit there, we do an annual computation. In fact, the IRS's worksheet for computing a basis in your interest as a partner that's included with the K1 instructions essentially does that. You start with last year's basis and you add the positives. You then take out your distributions, right? If distributions drive you below zero, those excesses will be a gain. If you still have some basis left over, then you go and offset your losses. If your losses would take you below zero, you just take losses to get you to zero, and then the other losses become carryovers to future years. So, the taxpayer, probably not unnaturally, you're used to, we have all done that for years. It's exactly how we handle the computation, is we do it that way. So you're thinking it's an annual computation, and it is, but only because, and this is where the court's going to come to, 704D requires you to make the computation whenever you get to a term of what of the K1 can be taken on the return. However, the court will say that 705 was not written to be annual, and 705 comes into play whenever basis becomes relevant. And that's how the court's going to differentiate this. What the court said in their decision was, they said, look, nothing in 705A makes any mention of per period calculations. It doesn't. You're not going to find a reference of calculating basis per period. And we're going to show you a contrast of that with 1367A for S corporations, where it specifically discusses your stock basis calculation for the current period, right, on a per period calculation basis. That's never done in 705A. So they're saying, no, the statute by itself, read it straight up, its plain language is a cumulative calculation, right? 704D is a separate calculation of view of the court, and it determines, well, in that case, if you have deductions and there's insufficient basis to use the deductions, then 704D tells you that you carry them forward. That way, basically we have these sitting off to the side, and they're able to be used. As we open up space again, the 705A calculation now suddenly has some room to take more deductions. We're able to take them off there. The court said, well, that's fine, but 705A, which is the calculation of basis, never anywhere says anything about whether or not you actually, essentially, an allowed deduction is not necessarily just one that has been formally, like I said, let's say it's been formally one you should have taken. It's almost going with the concept of an allowed deduction. Remember, allowed versus allowable on depreciation? Conceptually, the court is saying those deductions you took you shouldn't have, because the statute is closed, they are now allowed. But now an allowed deduction under these calculations would always reduce your basis. So saying that, yeah, we still have the basis reduction going in. That would be their background. Now, as I said, 705A, no specific restriction is in 705A on including losses based on annual basis calculation. Everything 705A talks about, you remember that text we had a couple minutes ago, all of them are talking about lifetime amounts of income flowing to you, lifetime amounts of losses flowing to you, and lifetime amount of distributions. So, it's a lifetime calculation, and in the court's view, this is just a calculation that must be made at the point it is needed, as needed basis. Now, it's always going to be needed at the end of every year to determine if you have a 704 issue or if you have a gain on distribution issue. So we'll always bring it up at the end of the year, but there are other reasons we would bring this up. So every time you need it, it is a cumulative calculation. It does not rely on the last ending one to make it work. It is a cumulative calculation, which hopefully will agree with all of your, with this whole annual beginning, ending, and all that stuff. It should if you've kept everything correct. But the court's saying that annual calculation is not the governing one in the case of a partnership. Rather, it is this cumulative calculation, which is redone every time you need it. The fact that it would have been limited in losses that could be, if calculated on a different date, that could be included if you calculate on a different date, does not impact calculation at this point on a cumulative basis when the basis is not below zero. We now have the room to calculate. We now have had enough positive basis things added to be able to take another $3 million in losses that we couldn't take in 14 or 15, but we now are able to take it now. So it's able to reduce basis under 705. Because 705's only restriction is you can't go below zero when you finish this calculation. If you do, then for right now, the basis is zero, and 704D normally would be holding losses carryover, or you'd have a gain. But, that's the idea. But if you screw that up, it doesn't matter. Those distributions and those losses still impact things. So we have to kind of look at that. Now, like I said, the big question was, because of the case that started this, apparently changed the IRS mind about using a suspense account, is does this apply to S corporations? And the article we had from Tax Notes did suggest that maybe, some people thought that it did. There was a nice back and forth among a couple of attorneys regarding whether this decision is valid for partnerships. And obviously, they tended to be critical of it because, normally, Tax Notes are going to be talking to attorneys who litigate these issues. And I'm pretty sure they don't like this idea. They'd much prefer to be able to say that, once it's done, we're through. So I wasn't totally surprised by them. They could very well be right. I don't know that other courts are going to agree with this one, but I'm also far from sure other courts are going to disagree with it. So I'll put it that way, the way I'd read it. But the S corporation issue was more interesting. And there was a split. While one person who had been one of the attorneys that they had been interviewing and who had said he didn't think that this opinion would stand, while he thought that it should work for S's as well, in theory, there was a kind of a different issue here about the S context. My take is, believing more with the individual they quoted from KPMG, is that this is probably a case where no, S's are different, because 1367A is very different from 705A. Well, 705A never mentioned it. 1367A, when talking about additions to basis, talk about additions for such period. And A2, which is on reductions, talk about the reductions for any period are limited to this. So 1367 to me clearly suggests an annual computation where you do have to go with beginning and ending and keep it going forward. So it doesn't have the nice, easy language that indicated it must be an annual, it must be a cumulative computation. That's clearly the issue. Also, there's another problem with S corporation context. Basis isn't just one thing, right? In a partnership, you have basis in your interest, and that basis includes a share of the debt you're liable for, but everything's in one pool. Remember, in an S corporation, we have two different pools of basis. We have the stock basis, which operates under one set of rules, but then if we run out of stock basis and have additional losses, we then start going over to the debt basis set of rules, which are different. I mean, very different set of rules. It's not one pool of basis. And because of that, I would agree that there's no way, I think, to make this cumulative, and the statute doesn't try to word it that way. So I do think it's something different. Now, the question is, okay, if the IRS can't do this and can't use a cumulative method like 705A, what will they use? There, they may still be stuck with their suspense account theory, where they essentially try to leverage Regulation 1.1016-6A and argue that the suspense account is necessary to prevent a double deduction. Now, if you go back and read that article from July of 2023, you'll see the judge had some issues with that, because the judge is saying some of the things the suspense account doesn't seem to be preventing any sort of double deduction. He seemed to be okay if it did, if there was a true double deduction going, but he began to point out some real holes where, this might not work the way the IRS would like it to work, because, he was saying you got to show a double deduction under your theory, before we're going to justify using the suspense account to stop the problem. So, as I say, I have no clue what the service might do there. That's still open to question, but we will see the partnerships. Now, the partnership issue, as it stands right now, it is simply a tax court memo decision in a single case. It's not a reviewed tax court decision, so we don't know for sure that every judge would view this the same way. It also, of course, hasn't been subjected to the review process that, a reviewed opinion has everybody look at in detail. We'll also see if the taxpayer decides to appeal this case, or if somebody decides to appeal a case decided on a similar basis, to see if a court of appeals might agree with this analysis or not. But keep your eyes on it. Interesting case. If you have anybody who has claimed a loss in a prior year, you are aware it was excess of basis. That's why brand new client is the easiest way to run into this. What do you do? And Well, at least this gives you one idea about what the service was successful in one case in doing. Finally, we're going to talk about a few things that have come up in the past week, articles on tax notes, and I've got the actual articles. If you download the PDF with the slides and the citations, I have the actual citations back to the articles. Now, the one catch with those articles is, of course, they are on Tax Notes Today Federal, which means one must subscribe to Tax Notes Today Federal to read them. But we'll talk about most of the basics today. So we'll go down them. Now, there are going to be 3 articles we're going to look at here, and they're all dealing with the Tax Cuts and Jobs Act extension issues or other tax bills that Congress might take up. And there's lots of issues here about what are they going to be able to do, how quickly can they do it, and what's likely to derail them if something gets them off the tracks. Well, the first article we're going to look at is one that was written by Doug Sword and Katie Stanton. It was entitled "With Planning, TCJ Extensions May Pass Sooner Than Thought." That was in Tax Notes Today on the 12th of November. And this takes a look at how fast could this bill pass. And there they were talking to, I think, a couple of people who used to be on the committee staff in the tax committees at Congress. And they were talking about, well, how quickly can Congress move? What would be the fastest we might see this? And are they going for the fastest? Well, the staff said, best thing to look at is what the Democrats did in 2020, after the 2020 election, before they came in beginning of 21 and took over the Congress. What the Democrats did was they basically got their bills in place before the start of the session. Right? So all of that. And right now there are Republican working groups working on getting legislative language and stuff together and getting something everybody can sign off on before they all show up in early January. And, we end up with a bunch of other things happening. Now they're going to say, we can take care of all this. We can get this done. If we've got all of that agreed, then the Democrats managed to get their bill signed into law by March the 11th. So essentially about 2 months after they come in. That is probably what everybody thinks is about as fast as you can do it. None of the staffers seem to believe that you could, former staffers, that you could really speed that up much more than that. That was probably the optimal way to get it through, optimal number of hours. Because otherwise, there just certain things have to happen, certain procedures take place. And it would be very, very difficult to beat the March 11th date. So that would probably be the best news as it comes out about then. You got it good. Now, they did, though, explain there were a number of potential problems that could get in the way of this. First, it was pointed out that, the certain lawmakers are going to have issues if they try to repeal some of the Inflation Reduction Act tax credits for various structures, issues, special breaks for certain industries. The president-elect and clearly the Speaker of the House wants to, in our record, wanting to get rid of a lot of those energy-related credits that were added by the Inflation Reduction Act back in 2022. However, there are a number of Republican congressmen and senators who have some major electric projects, electric vehicle-style projects, that are in industries that are locating in or starting to fire up in their areas. And there has been more than a few reports that those people are not thrilled with losing these credits, which could cause their district to lose jobs. So we'll see how easy it is, because this is another one. And this is one of those things, too, I want to point out to you. If, in fact, those congressmen succeed in blocking it and succeed in saying, no, you got to leave all these alone when you write your new law, you might find that the Republicans, if they go ahead and do that, have suddenly lost a whole bunch of other lawmakers from their party who are insisting these things must go. Right? We have a number of people who've done. If you remember, although he's not a member of their party and he won't be in the Senate anyway at that point, but you may remember that Joe Manchin was kind of, yelling that a lot of these things should go. He felt he had been tricked into signing it by not having people fully explain some of the loopholes that were in play. So I would expect there may be Republicans who would say no. And now you're getting to the problem we're going to have of the thin majority. We'll talk a little bit more about that. We know a little bit more about what the majority will look like now. And It's going to be thin. It's going to be really thin for the moment. So we'll just leave it at that. Another big fight is whether or not the extension of the tax cuts need to be wholly or partially paid for by revenue offsets. In the Senate, the chair of the Finance Committee, Senator Kaplan from Idaho, and the just elected majority leader, Senator Thune from South Dakota, they believe that no pay-fors are needed for just extending an existing tax policy. However, it's definitely not clear that the deficit hawks in the House are going to buy that one. And, there is concern about the U.S. deficit, about the U.S. Debt, how much debt the U.S. government is carrying, the fact that we are now paying, interest at a explosive amount. I believe I was told yesterday that we are now, for the first time in our history, the interest on the debt is more than we pay for national defense every year. A bunch of that which we're borrowing, but that's a whole different issue. We're borrowing for everything right now. So yeah, there is concern about it getting up there, and there will be some in the House who are mainly concerned about the deficit. And was also noted, as I said, with the talk I attended, not yesterday, I guess it was Wednesday, in Portland, Oregon, that, when they did exit polling, asking people what key issues were, around 80% were concerned with the deficit. So this is going to be a fun one to run. Not having to pay for them makes it a lot easier to get all the goodies in. If you have to pay for it, there are two problems. You probably need to reduce the goodies because, they're not going to be able to raise pay-fors to offset everything. And number two, pay-fors by their very nature are unpopular because there are one of two ways to get it to go. Either you raise taxes somewhere else, and I know we'll call it raising revenue, but gang, it means getting more tax money in the door. To me, that's raising taxes, however you look at it. Or cutting spending programs. And while everybody swears there's a ton of waste in the government and we could cut billions and have no impact on anybody, the minute you actually go to cut something specific, suddenly those people who are impacted are very, very much saying that, no, this isn't what we were talking about. It was those other programs over there that you should go look at. And then finally, the SALT cap, which essentially derailed any chance in 2023 of getting a bill out of the House, and complicates other issues. We do have that issue there. Can we get anything? Can we get past a bill in the House, super narrow majority? Can we pass a bill in the House without making some concessions to the Northeastern and California Republicans? And if we do that, do we lose the Texas and Alabama style Republicans? And we don't, we can't afford to lose many of either category. So we may find that makes it very, 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 very difficult to pull this off. So we'll have to see what all of that does with this issue. Okay. Another article this week from Doug Sword basically raised the caveat that there may be a way to reduce the cost of this thing, which says TCJA's extension might be a short one. Again, from Tax Code State Federal on November the 13th. Now, as we know, we talked about it last week, right? Under the budget reconciliation package, you could have 10 years worth of increased deficits before you have to reset and go back to zero. We told, as we discussed last week, that requirement to get back to zero by the 10th year is why we see these bills pass, and then all of what's in the law, or a good chunk of it, disappears in year 10. Why do we do that? Because if we do that, that's what enables us to, work with this system. So we do that, and then we hope that eventually somebody will come back and extend these things, preferably not having to use the same process. This time, unfortunately, we're going to have to use the same process, which then limits doing anything new because you're having to spend all your money on protecting the old. But that's where we're here. When we did this last time, which was back in 2017, we did end up not using the 10 years. They decided they didn't want to spend any more than, I think it was 2.1 trillion. But the 10-year score was more than that for what they did, even with the revenue raisers they had. So what they decided to do was, the way we can cut that cost, we won't take anything away and not give somebody this. But instead of giving us, let's say, Section 199 Cap A for 10 years, we're just going to give it to you for 8. So that the end of the line comes up sooner. Well, there is a lot of speculation that this time, the CBO's projection for extending the entire bill for 10 years, so extend the TCJ and just like we have in 25, make it identical for 26 in future years. If you did that for 10 years, so we would be facing this problem again in 2035. That would cost $4.6 trillion. And that's based on current estimates. And it is expected the CBO, when they recalculate, which they do every year, their baseline numbers, that number is going to go up by a not insignificant amount. So the question is, nobody expects the Republicans are going to approve spending $4.6 trillion over the next 10 years. The question is going to be, how much will they spend? And then that will impact how much of a tax cut or how long these things can continue. There is a speculation that it's likely to be a good call, would be around 5 years. And they may or may not get that. Some would say down to 3 years. Some would even say the perfect extension would be 2 years. That then you could do everything and it wouldn't be much controversy, because you're only going to talk about 2 years in this case. The problem with 2 years, though, is, as is pointed out, that's probably politically a bad way to go if you're Republican. Well, this last senatorial election was a bad map for Democrats, by meaning that you had a lot of potentially seats that were, up for grabs. Those were held predominantly by Democrats, and they had way more seats up for re-election than the Republicans did. That reverses in 2 years. When we get to 2026, the Republicans are going to be defending a lot of seats and defending a number of seats that we might say that they shouldn't have won, right? That it was surprising they held the seat. That suggests that in 2026, control of the Senate will shift back to the Democrats. Everything stays equal. And the other reason why you think that's going to happen is because generally the party in power loses seats. So right now, the smart money is on Democrats retake the Senate in 26. Doesn't mean it's going to happen, but there are a lot of trends that favor them. They definitely have the tailwind this time. They were going to headwinds in this last run, and honestly, they didn't do as badly in the Senate as some had thought. I mean, it wasn't going to be a huge difference, but there was a lot of talk that maybe be 55 Republican senators. Now it's 53. It wasn't really that great. And by the way, there is a huge difference between 53 and 55, because remember, there's only 100 senators. And, that makes it really, much easier to hold together a group of 55 where we know it could drop all the way to 50. We're good, than 53, where now, again, we can't afford to lose the fourth one or we're in trouble. So that's kind of the big issue. Now, the article makes it very clear. The suspicion is whatever they can afford to spend is going to drive the number of years. But they clearly, for political reasons, they really want to get to at least 4 years. So what we're going to have to see is when we get that score out for what the 10-year extension cost would be, can they swallow 4/10 of that, basically 40% of it? That wouldn't quite be right, because it probably gets a little bit higher cost in later years because of assumptions CBO makes about growth, et cetera, in the economy and other issues and how things would grow. But, we're looking at that ballpark. Could they swallow, somewhere around 1/3 to 40% of whatever that projection is? And they're hoping that they can accept that. That could buy them 4 years. But again, that is 4 years of a straight up extension. If you want to do anything more, like get rid of the SALT cap or make a lot of types of income non-taxable, that will raise the cost again. And then the problem becomes, well, we could do it for a couple of years. And as I said, there are a lot of reasons why you do not want, if you're the Republicans, to do this for less than 4 years. You want to get to the next presidential election. You do not want things expiring in the midterms, right? Right at the time when you're likely to lose control. You don't want it to happen. You might not keep control of the next presidential election, but you're still likely to do way better then than you are going to do at the midterms, given our recent history on midterms. Finally, we look at the politics of the SALT cap. Right? And in fact, the article there, which is between Katie Stanton and Doug Sword, which says Slim House GOP majority faces slimmer SALT caucus, tax notes today federal, November 13th, 2004. That article discusses the politics of the cap on state and local taxes, right? Now, this election cuts both ways on whether what's called the SALT caucus, which is a bipartisan caucus, but to be honest, right now, only the Republican members of that caucus are going to count. Because, yeah, the Democrats are going to vote against this bill regardless, because honestly, the Republicans are going to design a bill to vote against, just as the Democrats designed a bill back in the, with the Inflation Reduction Act, the Republicans vote against. That was the design of the bill, right? In fact, generally, they'd be more concerned if Democrats voted for it, because it would suggest to much of their base that the bill obviously didn't go far enough. If the Democrats are willing to vote for it. So that's the kind of thinking we're in these days. So keep that in mind. Decision Desk HQ as of this afternoon, it's on Friday here, Friday afternoon, the 15th of November, shows 2025 House is at 219 Republicans, 212 Democrats, 4 seats left to be decided. And that means if all 4 of those go Republican, they could only afford to lose 6 votes. Seventh Republican jumps ship and the bill fails, right? That's important to know. In the worst case, they could only afford to lose 1 vote, right? Because that'd get them to 218. And at 218, so basically they could lose 5 votes, I guess, now. 6 votes gets them on the wrong side if they got every seat. So between 5 and 2 are how many votes they could lose. So as I say, any interest group in the Republican Party that has at least 2 Congress people that are willing to blow everything up, right, in the bill, in order, or say our way or this thing goes nowhere. Yeah, it just takes a couple of them to do that. Okay, and this is getting more complicated because we're also seeing the new administration reaching in and grabbing House members. And that complicates matters because there is going to be a process to fill their seat once assuming that they get confirmed. And we just had one yesterday who basically resigned his seat already. So that's already an open seat that it's open before we ever got to the next election, before we ever get to the beginning of the term, which means that, yeah, as it would stand right now, if they swore everybody in until they get that seat filled, they would be at, under this rule, 218 would be all they're sure of holding right now. And we have at least 2 others that have been appointed from within the House that would also at some point need to give up their seat. And you do run the risk whenever people give up their seat, it depends upon how the state fills the vacancy. States are in control of this. And if you have a state that, like Massachusetts, will require setting up a very temporary, interim person sitting there, and then hold an election, reasonably as soon as you can, that will fill the seat permanently. You run the risk of what the Democrats hit in 2010, which is that, the seat that was yours, in that case, Ted Kennedy passed away, and that seat went to a Republican initially. I say initially only because we actually got to the full-blown general election. That Republican senator lost out to Elizabeth Warren, who has remained a senator ever since. So, that's what happens. But there is always a risk you could flip seats. And that's a problem. These seats could flip. That, something could happen, early administration, people could sour on it for some reason, and that could be enough to flip these seats. So you got to keep an eye on it. We have had surprising flips early on in a new administration, in the past. So, just keep an eye on it. We flip seats. Those seats don't necessarily stay, well, they might not stay flipped later. You may remember that we flipped an Alabama Senate seat back when the last time that we had, now President-elect Trump came into office. He ended up with a problem in the Senate early on, when they tried to fill the seat of Jeff Sessions. That kind of fell apart in Alabama. And that one was as surprising. A Democrat winning a seat in the Alabama Senate was as surprising as a Republican winning the seat for Massachusetts Senate seat. So we've had those surprises when we hold these elections. So you need to be aware that could put things at risk as well. Right now, though, it appears there are likely to be 10 Republican members of the SALT caucus. And obviously, if all 10 of them make this a do this or we're not voting for it, it doesn't matter how many seats the Republicans win going forward. They wouldn't be able to overcome that. But the other problem is, if those people, if they do go back and say, okay, we're going to put SALT back in, the deduction, and figure out how the world to pay for it, they're likely to lose votes from red states, from very red states. Let's say Texas, Alabama, Idaho, etc. They're going to start losing votes from there. And that's going to make it then a real interesting balancing act. Leadership has a tough job here. They need to figure out how to design a bill and SALT cap's not the only issue of this type. They got to find one that can thread the needle to get 218 votes of Republican only, most likely. And how in the world do they get those votes? Because whatever you give to one group may very well cause you to lose votes from the other, or may lead to new demands from other groups who aren't really objecting to what the first group got, but if they got something, we want something, right? You start learning the purpose. And eventually, if that started happening, it's all going to fall apart. If every time you give into the next one, we get another one, that was the process falling apart. It became very close at the end of the Tax Cuts and Jobs Act vote back in 2017. It began to look for a little while there at the Senate that we were going down that path where every time they gave in a concession to one person, somebody else came in the room and wanted a new concession. They did manage to stop the bleeding eventually and are able to get a bill through with the requisite number of votes. But yeah, it's one of those problems. So anyway, keep your eyes on all of this going forward. This has been the Current Federal Tax Developments for the week of November the 18th, 2024. Current Federal Tax Developments brought to you by your state society of CPAs and by Kaplan Financial Education. You can find me, Ed Zollers, at currentfederaltaxdevelopments.com. I'm available there. Also, I do participate on the Connect sites that are operated by the state societies in Arizona, New Jersey, Minnesota, Illinois, and also Idaho. If you have any questions, you can post to those sites. If I see your question, I may be able to respond and give a quick answer. Otherwise, we are going to see you back here next week. In the following week, this coming week, I get to spend Monday in Minneapolis, which would be cooler than it's here by a decent amount. Not horrible, but cooler, much cooler than here. Definitely not as cold as I've been in before going to this conference in Minneapolis, doing it. And so I have a few of those going on. I'll be doing some other sessions during the week. Later on in the week, I'll be doing a session, I believe. Yeah, I'm doing it for Tidewater in Virginia. Got a session there coming up at the end of the week. So I've got some things in between and got some client work to do in the middle of all that too. So we'll take a look, see how things are going. Take care. We are coming up shortly on the Thanksgiving break. Yeah, tax planning season runs really fast. So we'll be sitting there and doing that. But I do look forward to seeing you all here next week on Current Federal Tax Developments.